Welcome to the MUFG Global Markets Podcast with Ehsan Khoman, Head of Emerging Markets Research, EMEA. It's Friday, 25th June 2021, and this week we're looking at the first half 2021 performance of emerging markets. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only. Ehsan, we're approaching the end of the first half of 2021, and it's been rather unexpected for emerging markets. How would you summarize the first 6 months of this year?
Thanks, Ona. So yes, while 2021 started with an upbeat tone on expectations of a synchronized global upswing as vaccine rollouts accelerated the pace towards a post-virus equilibrium, the emphasis of the reflation narrative has hastily shifted to inflation rather than economic growth. Now, indeed, Ona, if we recall back early in 2021, the Northern Hemisphere's winter months brought a resurgence of COVID-19 that, from a health perspective, was materially worse than the initial wave for the majority of emerging markets, which in fact transpired to further more infectious strains, particularly in parts of Brazil, South Africa, as well as in India. Yet despite the severity of the virus situation, economic output across most emerging markets has in fact been quite resilient, which we attribute to two factors. First, relative to the first wave in the spring of last year, the incremental tightening in physical distancing measures, as measured by the Oxford University Stringency Index, was and has been more limited. In other words, the brunt of the lockdowns have remained in place, and so there has really been little else to restrict in terms of mobility. Second, our examination finds that economies have become better adapted to living under lockdown restrictions. In essence, the relationship between economic activity and lockdown measures has been weaker than during the first wave. So put differently, we are better in embracing and living under the virus conditions than we are compared to last year. Now, beyond these two factors, encouragingly, the number of COVID-19 cases and fatalities has now fallen sharply across emerging markets, allowing lockdown measures to ease. And as vaccines progress, there is rising optimism that we are in the final stretch now of the virus, with lockdown restrictions likely to be increasingly lifted back to pre-virus levels more sooner rather than later. Now, Ona, from a financial markets perspective, the first half and the shift back to inflation then growth has generated mixed blessings for emerging market assets, given emerging markets, excluding developed markets, Asia has been on the back end of the takeoff slots for recovery, being dragged down by continued COVID-19 headwinds, disappointing vaccines performance earlier in the year, and the lack of expansionary policy space. Now, having said that, growth-sensitive assets such as EM equities have fared quite okay so far in absolute terms. Indeed, global equities have already posted double-digit returns. Now, that said, this has largely led by developed markets, and particularly the US, and emerging markets equities have lagged their developed peers, largely reflecting the disappointing vaccine performance as well as the limited room for further policy support. Meanwhile, emerging market FX, which is another asset class that is sensitive to the activity cycles, has posted slightly positive spot returns so far this year and modest total returns, thanks to improving carry on the back of a decline in FX volatility and rising interest rates during the second quarter.
So can we be confident that the worst is behind us, Ehsan, and the road to recovery across emerging markets is increasingly more constructive?
Short answer, yes, indeed, Ona. I mean, the market's focus on the global reflation theme may have shifted quite speedily towards inflation, but this does not change the fact that the global economic activity, particularly across emerging markets, is recovering strongly following last year's COVID-19 induced slump. And we have already seen strong activity numbers among major emerging markets in the first and second quarters, led by a pickup in aggregate demand on the back of vaccination progress. However, Ona, for us, it's becoming increasingly clear that the recovery in the global economy that started with China and Asia last year, which was led by the US, is more sequenced than synchronized. Indeed, when we take a closer look at the consensus for this year's global GDP growth, it does reveal that upward revisions have largely been led by the changes in US GDP forecasts, which are at around 6.5%. which is substantially higher than expectations for other regions such as Europe and parts of developed Asia. Now, better growth prospects for Europe in particular, that the continent has taken kind of the baton from the US in terms of driving global growth forward with accelerated vaccines, should bode well for emerging markets, as the region is still the largest market for emerging market exports on an aggregate basis, as well as Europe remaining the largest capital provider for emerging markets. And so, the influence of Europe on emerging markets is robust, and loose financial conditions in the Eurozone and strong growth in the region have a positive impact on EMs in the second half of this year.
And beyond Europe, Ehsan, what is driving your positive outlook for emerging markets in the second half of this year?
So, beyond the promising recovery in Europe aiding emerging market growth, we view that three core drivers of EM resilience as we head into the second half of 2021. So first, EMs comprise a higher cyclical sensitivity to global growth rebound and rising commodity prices. So compared with, for example, the 2013 taper tantrum, which featured sharp upgrades in expectations of US infrastructure expenditures, the current increase in commodity prices has been quite intense, which reflects a global growth supported tightening in commodity markets, and notably for copper, which reflect expectations of Chinese demand that is quite solid. Second, we have a resilient Chinese backdrop, and even with some degree of policy tightening in China, pervading strong Chinese growth conditions is a very strong positive for EM assets as compared with the more material deterioration in Chinese growth, which led up to the 2013 taper tantrum. Third and finally, we have a very healthier emerging market external balances. So setting aside global factors, EM resilience at the current juncture is in part explained by the fact that relative to much of the post-Great Financial Crisis period, EM external balances are significantly healthier compared with most other times in the post-GFC era, even among the more higher yielding countries that traditionally run current account deficits. And therefore, the EM complex is less reliant on external financing. So, to wrap, looking forward, we acknowledge that our constructive EM view is kind of being tested with this vindictive reflation stemming from US overheating and sticky inflation, keeping US rates and volatility elevated. However, there are reasons to not go overboard with the Fed's hawkish tone recently, and we continue to hold conviction of a more benign version of reflation centered on a continued global recovery, further upside in commodities, limited spillage in Chinese growth expectations, and continued strength in EM external balances. And as witnessed in February, emerging markets can be resilient in the face of even sharper rise in US yields, and we remain quite constructive as we head into the second half of this year.
Great to hear this insight, Ehsan. Thank you, and we'll speak to you next week.
Thanks, Anna. Talk to you soon.
Thank you for listening to this MUFG Global Markets Podcast. Rate, review, and subscribe, and contact your sales rep for more information. Come back next week for more insights from the Global Markets Research Team.